Looking at this early photograph of Wall Street, the heavy stone columns and imposing architecture were designed to project total, unquestionable stability. For over a century, this financial district has run on a single, invisible currency, implicit trust, and the assumption that the people inside these buildings are absolute financial geniuses. But that very trust creates a dangerous blind spot. When you assume the person managing your money is infinitely smarter than you stop asking hard questions. Highly educated professionals, from doctors to corporate lawyers, become remarkably vulnerable when a so-called genius quietly promises them exclusive access to a guaranteed return. Which brings us to the man who exploited that vulnerability better than anyone in history. Bernard Madoff looked like a former chairman of the Nasdaq Stock Exchange and a deeply respected pillar of the financial community, because that is exactly what he was. His reputation was so bulletproof that government regulators completely missed the math. When auditors visited his offices to investigate anomalies, they were intimidated by his status. They accepted vague answers, ignoring glaring red flags, because they simply assumed Madoff was operating on a level they couldn't comprehend. His success relied on a basic flaw in human psychology. The entire financial ecosystem, from private banks to charity boards, wanted his impossible numbers to be real. They chose not to look at the mechanical gears of his operation because the results felt too good to give up. To understand how he fooled them, we have to strip away the Wall Street mystique. Underneath the expensive suits in the Manhattan office, Madoff was running the most primitive financial trap in existence, a Ponzi scheme. Let's look at this diagram to see how a Ponzi structure actually begins. It starts small. You give an operator 1,000 rupees to invest. In exchange, he promises to give you 1,200 rupees next month. The deception happens immediately. The operator never invests your money. Instead, a second person walks in and hands over their own 1,000 rupees. The operator simply takes that new cash, hands 1,200 to you, and pockets the difference. Now you think you found a financial wizard. You tell your friends. They tell theirs. Dozens of new people rush in to deposit cash. The operator uses that flood of new money to constantly pay the returns of the older investors. The cash simply moves in an endless circle. Every time someone gets a payout, the illusion grows stronger. But mathematically, the operator is digging a deeper hole. With every single new investor, the total amount of promised money outpaces the actual cash coming in. Why is a system like that guaranteed to fail, while the actual stock market can generate wealth for decades? On the left side of this split screen, we see legitimate investing. You exchange your capital for ownership in real, tangible assets, a fraction of a factory, a piece of commercial real estate, or stock in a tech company. Those assets produce real goods and services, which inherently generate upward trending value. Now look at the right side of the screen. In a Ponzi scheme, capital moves directly from a new investor to an old investor. It never converts into an asset. It never buys a factory or a bond. It simply changes pockets. Because no asset was ever purchased, zero real wealth was created. Every single dollar of profit Bernard Madoff ever mailed to a client was entirely fictional. It was simply stolen from the person standing next to them in line. Without actual assets generating value, a Ponzi scheme operates like a biological virus. It has to constantly consume new hosts to survive, meaning it only has two ways to die. First, the pool of eager new investors eventually dries up. You run out of people willing to hand over their cash, starving the system of the fresh capital needed to pay the original participants. Second, panic sets in. A broad macroeconomic event can scare clients into withdrawing their funds. If too many old investors ask for their cash back at the exact same time, the empty central reserve drains instantly. The structure collapses inward. In late 2008, the global economy tanked. Panicked clients asked Madoff for $7 billion in returns. He only had a fraction of that left. The cash ran out, he confessed to his sons, and he was arrested, instantly evaporating billions of dollars of his clients' life savings. This collapse followed the inherent mechanics of the structure Madoff built on day one. It was a mathematical certainty, regardless of market conditions. Gravity always wins against bad math. If the math was a ticking time bomb, how did a single man hide a multi-billion-dollar deficit for decades? He did it by weaponizing vocabulary. Whenever clients asked questions, He buried them in a smokescreen of complex financial jargon. He threw around words like arbitrage. In reality, arbitrage is incredibly simple. It just means buying an asset cheap in one market, like gold in London, and immediately selling it for a higher price in Tokyo to pocket the difference risk-free. Madoff claimed he used a hyper-specific strategy called convertible bond arbitrage, which involves buying a company's debt and converting it into higher-value shares. It sounded brilliant to clients. It was also completely made up. He would talk about securing a counterparty, which is nothing more than the person on the other side of a trade. If you buy a stock, the seller is your counterparty. He referenced collateral, a common term for a physical asset, like a house or a car, kept as security by a bank to guarantee a loan. His deception broke one foundational rule. Legitimate institutions practice asset segregation. Client money is securely locked apart from operating funds. Madoff ignored this. He dumped billions of client capital into a single, unverified bank account to spend as he pleased. Financial jargon often masks a lack of transparency. If a guaranteed return lacks clear evidence of separated asset-backed wealth creation, you are looking at an illusion. We often imagine the architect of a multi-billion-dollar financial crime as an evil math genius, sitting behind a wall of monitors and executing a complex day-one blueprint. But Bernie Madoff's scheme likely began with something much more mundane. He suffered a standard trading loss and lacked the courage to admit he had failed. To hide that initial failure, he lied, but hiding one lie required a second, then a third, forcing his entire business into a complete fabrication. The largest Ponzi scheme in history wasn't a masterpiece of finance. It was the permanent psychological expansion of a single, pathetic cover-up. Maintaining a fraud of this scale required a physical paper trail, convincing evidence of trades that never actually happened. In a backroom, Madoff's employees pulled real historical market data to manually type out fake statements, backdating buy dates, sell dates, and profits to match the market's past performance. It was the financial equivalent of a teenager printing out fake scorecards for a cricket match that was never played. A multi-billion-dollar empire rested entirely on the fragile illusion of manually typed paperwork. This raises the central mystery of the Madoff era. Why did the smartest financial minds on Earth fail to verify these obvious fakes? Much of it came down to reputation capital. Madoff was a respected Wall Street veteran and former NASDAQ chairman. He was an institution. His reputation functioned as a logic shredder. Instead of auditing the numbers, investors looked at the name and assumed reality matched the pedigree. When authority speaks with this much weight, the human brain naturally shuts down its critical thinking defenses. With Madoff's status cemented, the investment frenzy was sustained by social proof. Elite banks, charities, and wealthy families handed over their fortunes simply because they saw other rich, successful people doing the same. A fatal assumption took hold. Everyone in the chain believed that someone else, higher up or more qualified, had already checked the reality. The fear of looking stupid or missing out on the smart money eradicated independent verification among the global elite. Madoff also looked inward, targeting closed, high-trust networks like Jewish communities and elite country clubs. This is the mechanism of affinity fraud. A recommendation from a stranger is met with skepticism, but a tip from a trusted friend or an uncle bypasses our natural defenses. Within these tight-knit circles, trust spreads like wildfire. One person vouches for him, and soon an entire community is invested. Madoff didn't need a sales team. By weaponizing intimacy, he turned his victims' closest loved ones into his most effective recruiters. To maintain demand, Madoff utilized the scarcity effect, manufacturing an illusion of extreme exclusivity. Access was strictly gatekept. He demanded massive account balances, required inside referrals, and routinely turned money away. This triggers a hardwired instinct. The more difficult it is to enter a group, the more intrinsically valuable our brain believes that group must be. By acting as if he didn't need their capital, Madoff manipulated the world's wealthiest people into begging him to take it. The operation's ultimate defense was a counterintuitive tactic, the illusion of transparency. Madoff flooded his clients with thousands of pages of detailed tax forms and trade confirmations. It was a logic trap. Investors assume a fraudster will hide in the shadows, so the presence of exhaustive, granular detail feels like a guarantee of legitimacy. Ultimately, Madoff's scheme wasn't a triumph of high finance. It was a devastating hack of the human brain. The greatest financial risk was never the market. It was a hardwired bias toward blind. Investors handed Bernie Madoff billions because he promised the holy grail of finance, perfectly steady, predictable returns that practically never lost money. When his empire finally collapsed, the public assumed he had hidden his tracks with complex, high-level Wall Street wizardry. In reality, he hid behind basic, provable mathematical lies. To understand how the largest financial illusion in history actually worked, we have to look closely at the machine he claimed to have built. Madoff told his clients he used a specific technique called a split strike conversion. The stated goal was simple: generate moderate, consistent profits, while aggressively limiting any potential losses. This diagram illustrates the strategy. First, buy reliable blue-chip companies from the S&P 100. Second, buy protective put options, insurance policies in case the market crashes. Finally, to pay for that insurance, sell off your potential for high-end profits. In real-world terms, it is exactly like driving a car that has a strict, unbreakable speed limit, but is entirely surrounded by deployable airbags. It is a genuinely safe way to navigate the stock market. Your downside is highly protected and your upside is firmly capped. But the math dictating that strategy is grounded in reality. There is absolutely no magic involved. This graph aligns Madoff's reported performance with the actual behavior of his stated strategy. Financial analysts fed real, historical market data into the split strike model, and the result is this jagged line, showing the expected volatility of the real world. Madoff's reported returns, however, follow an impossibly smooth upward trajectory. This breaks the basic law of correlation. Madoff's strategy explicitly required him to hold real stocks in the broader market, so when the global markets experienced a heavy crash, his portfolio had to be violently dragged down with it. Instead, his returns floated perfectly upward, completely ignoring the collapse. Claiming this immunity to a market crash is like telling someone you drive on public roads, but traffic jams simply phase right through your car. Defying the macro gravity of the global economy is impossible. When a dataset entirely ignores the environment it lives in, the numbers are entirely fabricated. Wall Street uses a specific metric called the Sharpe ratio to evaluate performance. It measures exactly how much return an investment earns for every single unit of risk the manager takes on. For decades, Madoff reported a Sharpe ratio that was astronomically high. He achieved a level of month-over-month, year-over-year statistical consistency that simply does not exist in real financial markets. Looking at his track record is like watching a cricket player hit a batting average of 99 every single season for 30 years straight. This level of sustained, flawless perfection in a chaotic system indicates a dataset that has been fabricated from the top down. The impossibility of Madoff's math extended straight into his physical, back-office operations. Any first-year auditing student could have looked at his setup and spotted three massive operational failures. First, Madoff managed tens of billions of dollars for global clients, yet his official auditor, the entity responsible for verifying those billions, was a tiny, unknown office staffed by a single active accountant. Second, he practiced self-custody. Standard financial law requires a strict separation of powers. The person managing the money, the custodian holding the assets, and the broker executing the trades must be completely separate entities to prevent fraud. Madoff acted as all three. He directed the trades, held the cash, and printed his own statements. He was a student taking a final exam and immediately grading his own paper. The third failure was a hard physical limit. Analysts eventually measured Madoff's stated options trades against the real-world market capacity. The entire global options market physically was not large enough to absorb the volume he claimed to be executing. It is exactly like someone bragging that they just bought 500 pizzas from a local shop that only makes 50 total pies a day. These physical bottlenecks stripped away the final layer of the illusion. You cannot execute trades for assets that do not physically exist in the marketplace. Analyst Harry Markopolos looked at Madoff's returns and immediately deduced the truth. He knew the numbers were fake based entirely on mathematical impossibility. Markopolos compiled the math, documented the red flags, and repeatedly delivered his findings to the Securities and Exchange Commission. But despite holding concrete, irrefutable evidence that the largest fund in the world was mathematically impossible, the SEC completely ignored his warnings for years. Ultimately, Madoff's fund survived through decades of institutional oversight failure. In the end, the math provided the only The Securities and Exchange Commission is the ultimate market regulator, tasked with detecting fraud and protecting investors. During their investigations into Bernie Madoff, they focused entirely on procedure, obsessively checking if his firm was breaking specific trading rules. They scrutinized the paperwork while ignoring the only question that actually mattered: did the trades even exist? Instead of searching for outside proof, the SEC based their entire audit on self-generated documents handed to them by Madoff himself. Regulatory oversight is useless when investigators rely on the suspect to provide the data. Every legitimate U.S. trade leaves a permanent electronic record at the Depository Trust Company, or DTC. A single query from the SEC to the DTC would have bypassed Madoff entirely, revealing that his firm held 0 securities and executed 0 trades. This one independent check would have instantly ended the multi-billion-dollar illusion. Financial systems are only as secure as their highest point of independent verification. The 2008 financial crisis acted as a brutal, system-wide stress test. Banks collapsed and markets crashed, creating a sudden, desperate demand for hard cash. Panicked investors rushed to Madoff all at once, demanding their money back. Ponzi schemes always die from sudden liquidity pressure. A collapsed economy forces a mandatory verification of actual cash reserves that fake documents cannot hide. Madoff faced a sudden $7 billion liability as investors scrambled to withdraw their funds. His actual bank account held only $234 million. With the cash exhausted and no real investments to sell, the illusion shattered instantly. After Madoff confessed the lie to his sons, the FBI moved in for the arrest. Mathematics and the exhaustion of liquidity ended the scheme before law enforcement ever intervened. Years of lawsuits followed as investigators worked to recover the missing billions. Courts used the clawback concept to retrieve funds. When money moved from a new investor to an earlier one, it was labeled as fake profit. Every dollar withdrawn by early investors came directly from newer victims' deposits. The courts forced early investors to return these fake profits to a central pool for redistribution to those who lost everything. Ultimately, in a collapsed system, the courts must legally reverse the flow of capital to establish true ownership. The Madoff disaster provides an essential checklist for modern internal controls. Real markets inherently fluctuate. Smooth, consistent returns are a primary red flag of a manipulated record. Reputation is a poor substitute for evidence. Outsourcing critical thinking to famous or high-status figures invites disaster. Always demand independent verification. Reports or screenshots provided by the person managing the money are inherently untrustworthy. Effective systems require the segregation of duties. One person should never hold, manage, and audit the money simultaneously. Fraudsters exploit the human fear of missing out and the social pressure to avoid asking uncomfortable questions. Internal controls serve as a necessary defense against these shared psychological vulnerabilities. Madoff's success relied on human connection rather than complex financial engineering. He weaponized trust to bypass the skepticism of even the most sophisticated investors. Once humans feel emotionally secure with a person, they often voluntarily disable their critical verification skills. Fraud takes root the moment blind trust